Economic indicators point to a possible recession in 2024. Have you ever wondered what superpower would enable you to make the most money possible without resorting to criminal activities? While seeing the future is impossible, economists have developed leading economic indicators that can provide insights into potential recessions. In the next few minutes, we will explore some of these indicators and discuss how they are currently pointing towards a recession in 2024. Gross domestic income, GDI, as a leading indicator. GDI is a measure of the income generated within an economy, while gross domestic product, GDP, measures the value of everything produced. Normally, GDI and GDP should be similar, as every dollar spent or lost is someone else's income. However, recent data shows that GDI has started to decline while GDP continues to rise. Historically, whenever GDI moves into negative territory, a recession follows. This pattern is evident when comparing GDI and GDP charts. Currently, GDI has just moved into negative territory, indicating a potential recession in 2024. The yield curve and stock market rally. The yield curve, which compares interest rates on short-term and long-term debt, is another leading indicator of a recession. When the yield curve inverts, meaning short-term debt has higher interest rates than long-term debt, a recession usually follows. Additionally, historical data shows that even if the stock market rallies after a yield curve inversion, those gains are eventually reversed. This pattern has been observed before the Great Recession and is currently being seen in the stock market rally since the yield curve inverted. The Federal Reserve and the Cleveland Fed are both aware of this indicator and are predicting a recession in 2024. The Conference Board's leading economic index. The Conference Board compiles various leading economic indicators into one index. The U.S. Leading Indicators Index has fallen again in November, indicating a potential recession. Looking at the components of this index, including the S&P 500, consumer expectations, and building permits, it is clear that all indicators are pointing towards a recession in 2024. The leading economic index has been severely negative for some time, and historically, this has always preceded a recession. The stock market and bull market comparisons. While the stock market is not a direct reflection of the economy, it can provide insights into future economic conditions. The recent stock market rally, although positive, is relatively small compared to past major advances in the S&P 500. Additionally, the Russell 2000's outperformance still leaves it with one of the worst 18-month performance gains since 1982. These indicators suggest that the recent stock market rally may be a trap for retail investors, who often buy at the top and sell at the bottom. Conclusion. While these leading economic indicators do not guarantee a recession in 2024, they provide strong evidence of a potential economic downturn. It is essential to be prepared and protect your investments from large drawdowns. By understanding these indicators and managing your investments, you can beat the averages and safeguard your portfolio. Consider subscribing to our All Things Money channel, where you can learn how to self-manage your investments and navigate uncertain economic times.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.